Have you ever traded with the cup and handle pattern? Do you know how to identify it? Welcome to our insightful discussion on one of the most critical chart patterns used by traders, the cup and handle pattern. This pattern, resembling a teacup in its visual representation, is no less than a compass in the vast sea of market trading. It guides traders to navigate through market conditions, helping them understand when a financial instrument is likely to experience a bullish upward trend after a period of market consolidation. It's a powerful tool, but like any tool, its effectiveness depends on how well you understand and use it. So, whether you're a seasoned trader or a newbie stepping into the intriguing world of trading, the cup and handle pattern is something you should be familiar with. By the end of this video, you will learn how to identify and use this pattern in your trading strategies. The cup and handle pattern is a chart pattern that traders find extremely useful. But what exactly is it? Let's dive in. Think of the pattern as a teacup viewed from the side. The cup is a bowl-shaped depression in the price chart, showing a period where the market took a breather, with prices falling and then rising again to the original level. This forms the U shape of the cup. It's a time of consolidation, of treading water, before the market gears up for a potential rally. Now, imagine this cup has a handle. The handle is a short period of sideways or downward movement in the price chart, immediately following the cup. It's like the market catching its breath after the climb back up to the rim of the cup, before potentially taking off again. This forms the slight downward or sideways slant of the handle. But the magic happens with the breakout. The breakout is when the price moves above the resistance level, the rim of our metaphorical cup, with increased volume. This signals that the market is ready to embark on a sustained upward trend and is the point where traders may decide to enter the market. The beauty of the cup and handle pattern is that it can be found in all types of markets, from stocks to commodities to forex. It's a universal sign of a potential bullish trend, a beacon for traders looking for their next big opportunity. But it's not just about recognizing the shape. The cup and handle pattern is also about patience. It's about waiting for the cup to form, for the handle to develop, and crucially, for the breakout to occur. And it's about understanding that not every cup and handle will lead to a breakout. Sometimes, it's just a cup with a handle. Remember, the cup and handle pattern is all about recognizing the right shape and waiting for the breakout. It's a tool, and like all tools, it's most effective when used wisely and with a clear understanding of its limitations. Now that you understand what a cup and handle pattern is, let's discuss how to spot it in your trading charts. To identify this pattern, you're looking for two main elements. First, the cup, which is a U-shaped pattern that develops over time. It's a period of consolidation where the price movement is relatively flat or slightly down, followed by an upward trend. The handle follows the cup formation. It's a small downward drift with reduced volume, resembling the handle of a cup. One of the key strategies in identifying this pattern is to monitor the volume. The volume is usually high at the beginning of the cup formation, decreases as the cup forms, and then picks up again during the breakout from the handle. Now, why is the volume important? The volume pattern reflects the psychology of the market participants. High volume at the beginning of the cup shows that traders are actively selling their stocks. As the volume decreases, it indicates that selling pressure is reducing and a bottom is being formed. When the volume increases again during the breakout, it signals that buyers have regained control and a new bullish trend might be underway. Another strategy to spot the cup and handle pattern is to look for a certain duration. The cup formation should take at least several weeks to a few months to form. If it forms too quickly, it might not be a reliable pattern. The handle formation, on the other hand, should be relatively shorter, typically lasting for a week or two. Remember, the cup and handle pattern isn't always perfect. The depth of the cup, the height of the handle, the duration, they can all vary. But once you train your eyes to spot this pattern, it can become a powerful tool in your trading arsenal. Identifying the cup and handle pattern correctly is the first step towards successful trading. And with practice, you can increase your chances of making profitable trades. So, keep observing, keep learning, and let the cup and handle guide your trading decisions. So, how do you use the cup and handle pattern in your trading strategies? Well, let's dive into this. First off, recognize that the cup and handle pattern is a bullish continuation pattern that signals a buying opportunity. It's like a pause in a stock's upward movement, a moment for the stock to catch its breath before continuing its climb. To use this pattern in your trading strategies, you need to understand its two parts, the cup and the handle. The cup forms after an advance and looks like a bowl or rounding bottom. The handle is a relatively smaller retracement that forms on the right side of the cup, resembling a downward drift or a flag. Now, let's talk about when to enter a trade. The ideal entry point is when the price breaks above the resistance line of the handle. This is the signal that the stock is ready to continue its upward trend. But what about exiting a trade? This can be a bit trickier. Some traders may choose to exit when the stock reaches a predetermined target price. Others may prefer to hold on to the stock expecting further upward movement. The key here is to have a plan and stick to it. One of the most crucial aspects of using the cup and handle pattern is setting a stop loss. This is the price at which you will sell a stock to limit your loss if the trade doesn't go as planned. The stop loss for a cup and handle pattern is usually set just below the bottom of the handle. Remember, the cup and handle pattern isn't a guarantee of success. It's just one tool in your trading toolbox, but when used correctly, it can help you identify potential buying opportunities and manage your risk. Using the cup and handle pattern effectively can significantly improve your trading results. But as with all trading strategies, it's important to do your research, understand the risks, and trade responsibly. Let's summarize the key points about the cup and handle pattern. This chart pattern is a significant tool for traders, allowing us to anticipate potential market movements and make informed decisions. Firstly, the cup and handle pattern forms during a market uptrend. It consists of two main parts, the cup, which is a U-shaped pattern, and the handle, a slight downward drift. The cup forms when prices rise, fall, and then rise back to the original level. The handle is created when prices fall a little, forming a small downward channel before eventually breaking out to the upside. The key is to identify this pattern correctly. Look for a U-shaped pattern that resembles a cup, followed by a minor pullback, the handle. It's important to remember that the cup should be U-shaped and not V-shaped, and the handle should be smaller than the cup. Once you've identified the pattern, you can use it in your trading strategy. The breakout from the handle's resistance level is a potential buying point. Traders usually set a target price at a level that's the same distance from the breakout point as the depth of the cup. However, it's crucial to wait for the breakout to happen before entering a trade to avoid false signals. The cup and handle pattern is not just a tool for identifying buy signals. It also provides an opportunity to set stop-loss orders. A common strategy is to set a stop-loss order just below the handle's low point. This way, you limit your potential losses if the price doesn't break out and instead falls. In conclusion, the cup and handle pattern is a powerful tool in trading. It helps predict market movements, provides buy signals, and allows for efficient risk management. But remember, like all trading strategies, it's not foolproof. It's essential to use it in conjunction with other technical analysis tools and to always manage your risk. The cup and handle pattern is a powerful tool in trading, but it's essential to identify it correctly and use it effectively. Trading with the cup and handle pattern is not as daunting as it seems. It's like learning to ride a bike, hard at first, but with practice, it becomes second nature. As we've discovered, this pattern is a valuable tool in the trading world. But just like any tool, its effectiveness lies in the hands of the user. It's essential to spend time studying and familiarizing yourself with this pattern, to recognize it in real-time market situations. In your journey to becoming a proficient trader, remember, It's okay to seek guidance, especially when you're starting new trades or dabbling with new strategies. Consulting with a financial advisor can provide that much-needed insight and perspective. They can help you navigate the complex world of trading, ensuring that you make informed decisions. Remember, knowledge is power, and the more you understand about trading patterns like the cup and handle, the better trader you become.